Welcome back to Learn SKN, and today we're going to be looking at the May-June 2020 paper 1 for principles of business. So May-June, or May to be exact, May-June exams. That's the exams from last year, the controversial exams. So we're looking at the May-June 2020 paper 1, principles of business. And so we're going to just jump right into it. We are going to do this in chunks, in pieces. So we're going to have about 3 videos total for this paper. So if you want to see it to completion, what you have to do is, of course, subscribe, hit the notification bell, and of course also like the button, like the video, and share. Alright, so make sure you subscribe to get the rest of this video. So let's jump in the first 20. We start with the first 20. Number 1. One feature of a free market system is that, and so the answer here is, producers are allowed to supply what customer wants. Now we see the options here. A. Competition is decreased among producers. Now with the free market system, you have the ability to produce whatever you want, and so therefore that would increase competition, because anybody can produce what they want when they want, and the market determines the needs, the wants, and the supply and demand, basically. So this cannot be the free market, because it doesn't decrease competition, it increases it, because it's like a free-for-all. Then we have B. The government is the major controller of decision making, and we all know that this is one of the key features of what you call the communist or the authoritarian or the controlled economy, where the government has all the control over the economic decisions. Then we have D. Both the government and producers are involved in the decision making, and of course that cannot be correct, because that describes what we call the mixed economy. So they have a piece for each type of economic system out there except the traditional. But so C is the answer. Producers are allowed to supply what the consumer wants. So in the free market, the market forces, supply and demand, are the ones that control what is produced, the market. So the producers are allowed to supply what the consumer demands. Alright, number 2. Which of the following are not trading instruments? And so you have options. You have the check, credit cards, bill of exchange, and money remittances. And so the answer is D, because money remittances, that's the money that when somebody goes overseas to work, they would send it back to the country, to their home country. And so that's what we call remittances, when you send back the money to your home country from overseas. And so we all know that checks can be used to pay for items, credit cards can be used to pay for items, bill of exchange can be used in place of cash, checks, or credit card, or whatever. So the first 3 are all trading instruments, whereas money remittances, you cannot go to a supermarket and say, sell me these because I'm getting some remittances from a friend tomorrow, and so that's not a bill of exchange. People have the right to say no if they don't want to give you on credit. So the money remittances is the answer. Number 3, the policy of a company are usually formulated by and of course you have the auditors, the directors, the managers, and the shareholders. And so the best answer here is B, the directors. Why I said the directors is because the directors give a general policy of what the company should be doing, and then the managers are the ones who carry out that policy on behalf of the directors. Of course, shareholders are those who bought shares in the company, and so if that was the case, if the shareholders were to make the policy, it would have been a mess, because there's some companies that have thousands and thousands of shareholders because they sell on the stock exchange. So that would be a mess. Everybody can't have a say in how the company runs. Auditors, those are those people in charge of basically looking at the books, seeing how the books are being kept. You can have the internal auditors, external auditors, the more the accounting part of it. And so they are just focusing on more of the accounting, money part of everything, as opposed to the holistic view of the company. So the directors are the ones who go now and formulate the policies, and then the managers will come along and carry out those policies on behalf of the directors. Number 4, which of the following is not a function of money? And so you have A, indivisibility, B, store of value, C, measure of value, and D, medium of exchange. And the answer here is A. Why is it A? Because indivisibility represents the ability of the ability of something to divide. So they're saying that in this case, money cannot be divided. And even so, if they had divisibility, then you would have been talking about a characteristic of money, where money can be divided into smaller pieces. For example, a dollar can be divided into 4 quarts, or it can be divided into 10 cents, whatever the case might be. Store of value and measure of value and medium of exchange are simply functions of money. Money can be used to store the value. That's why you have your bank account. It can be used to store how much your bank account is, how much your net worth is. So it can be used to store your value. It can be used as a measure of value, meaning you can go into a store, you look at the price on the item, and that the price is given in a dollar value. And so it can be used to measure the value of items, $5 for this, $10 for that, whatever. Medium of exchange now simply means that the money can be used to purchase items, goods or services. So you can get a good or service and you're going to exchange it for the money. And so indivisibility, that's not even really a characteristic, but if it was, you're acting for functions as opposed to characteristics. Some characteristics of money include durability, fungibility, divisibility, all those things. All right, number 5. Which of the following are advantages of a sole trader? And so you have 3 statements right there: ease of setting up, profit are not shared, and flexible working hours. And so the answer I chose to go with was A, which is 1 and 2, which is ease of setting up, which is true. Of all the business types out there, the sole trader is the easiest one to set up as it relates to paperwork. It's very easy to set up a sole trader as it relates to paperwork and those kind of things. Then we said 2, which is profits are not shared. You are the only one who invested, and so you are the only one who reap the rewards. You are the only ones who get the profit. Now this one can be a little. You have to think about this one. Number 3, flexible working hours. Now the reality is this: if you own your own business, you can basically do what you want. You can come in when you want, close when you want, go home when you want, take vacation when you want. So in that sense, you can say you have flexible working hours. But the thing is, when you're a sole trader also, you cannot afford to take away much time because there's no one to run the business for you. And so if you leave, you're going to lose money. So if you're not willing to lose money, it can be detrimental for you to have flexible hours as a sole trader, because you come, somebody expect you to be open, you're not, you can lose business like that. It's not like you're a partnership or something that have other people to step for you. So depends. If for on CX level, I think they're asking for 1 and 2, because as it relates to flexible hours, one of the disadvantages they state in most of the textbooks is the fact that sole traders cannot take time away from the job. If they take time away from the job, it's going to be detrimental to them. So that is why we're going with A, 1 and 2. Number 6. The management team of Scoot Motor has discovered that the productivity levels of workers have fallen. The team met and, without consulting the workers, took a decision to shorten the coffee break and lunch period. What leadership style has the management team utilized in making its decision? And so I have autocratic as the leadership style, but the other options include democratic, charismatic, and laissez-faire. And so one time, it's not going to be laissez-faire or charismatic. You know that. So this one is got to be between A and B. And so A was chosen for the simple fact that they did not consult the persons who the decision is going to affect most. They didn't ask them their opinion, they didn't ask for their input, nothing. They just went ahead and just thrust the decision on them. Like, this is the decision we came up with, and that's it, you live with that. Now, some might argue and say it could be democratic because, he would have met with a team. Without consulting the work, he met with a team. So, in some instances, people would think autocratic simply means one person, one leader, boom. But you have a team. Just like the Chinese government, they have a whole lot of different members, but it's authoritarian still. But so the team here acting as an authoritarian leader. All of them one head, and they said not to consult those who are affected most. And so that's why it comes on the side of autocratic. Democratic would normally consult everybody, most of the stakeholders who are going to be affected by whatever decisions. And so the best answer is autocratic. Number 7. Which of the following are benefits of written communication? Again, you have some options. Provides evidence, provides instant feedback, useful for detailed messages. And so right off the bat, you can see that provides instant feedback cannot be in any of the answers, because writing doesn't provide any instantaneous feedback. Just for that, face-to-face is king for that. Face-to-face. You talk to me, I answer back, I reply right there. That's almost instantaneous feedback. You know, you ask a question, you get a yes, you get a no, right there, face-to-face. You know, writing simply means you have to sit down, write, get it to the person, and then the person has to read it, you know, process whatever, and then reply. So that's not very instantaneous in terms of feedback. But what it is, though, is that it provides evidence. That's why people normally put things in writing. It provides evidence. You can, you know, have the paper trail. And also, it's useful for detailed messages. Because, you know, if you use a text message or a tweet or something, some of them have character limitation. You know, so a tweet is like, what, 240 characters? You can't go beyond that. So some of them have limitations. But when you're talking about detailed messages, you can write. Okay, you can write forever, outlining. I mean, that's why books are books, right? Novels and stuff, because they can give intimate details just with words. And so the best answer there is 1, provides evidence, and 2, useful for detailed messages. Number 8, under which of the following categories would subsidized meals for employees fall? Options: fringe benefits, duty allowance, wage and salaries, and workers' compensation. And so the best answer here is fringe benefit, because as you can see here, a fringe benefit is all those extra, like a car or something, all those extra things that come along with your employment. And so subsidized meals are meals on the cheap. Subsidized, they're cheaper than regular. So you get your lunch or break or whatever at a reduced rate. It's gonna fall back on the company. And so that's why we call a fringe benefit. Benefits outside of the regular stuff. Now, duty allowances, of course, to perform a duty, you need the allowances. So that's not on the end. That's not on the fringe. That's not on the outside of your regular work. You have wages and salaries. Of course, you must get your wage and salary. You must get paid. That cannot be a benefit. That's a fringe benefit. That's a must. You have to pay if you work. And then you have workmen's compensation. Again, if you do something and you're supposed to be compensated, you should be compensated. But fringe benefits are optional. They're outside of your regular payment. And so subsidized meals, they're not a must. Company just giving a little extra something. And so that's why it will fall under a fringe benefit. Number 9. Which of the following is a form of industrial action in which a trade union most likely to ask workers to participate? And so you have 3 options. All of them are part of industrial relations. You have mediation, bargaining, arbitration, and work to rule. The thing about these options is that mediation, bargaining, and arbitration involves just your representatives. You know, your stewards, your president, whoever is in charge of that chapter of the union. They're going to represent the entire body in mediation, bargaining, and arbitration. But work to rule means that all of you who are union members are going to decide to work strictly to the rule, which would in turn slow down the working day, slow down productivity, and cause the company to feel it in their pockets. So work to rule, if one person decides to work to rule, that's not effective. You need everybody. You need all workers to participate for work to rule to be effective. All the others, like mediation, bargaining, and arbitration, that's just somebody doing it on your behalf of the entire body. Alright? Number 10. Oldie but good. You know, seen this in a lot of papers in the past. Item 10 refers to the following diagram relating to the structure of an organization. And so you have X, you have the CEO, you have the other parts. Sales manager, production manager. Okay, good. Which of the following positions would best be suited at X? Right? And so normally, you would say that the CEO or the director is at the head of the organizational chart. But the fact that they have a CEO here means there's a body higher than the chief executive officer, higher than the person in charge of running the business day to day. So who is higher than the CEO? Is it the chief advisor? No. Is it the managing director? The managing director is also sometimes called the CEO. They can be used interchangeably in many cases. So is it the human resource manager? Of course not. HR supervisor is here, so the HR manager has to be here, right? So who is it? Who is all up there? The boards of directors. The board of directors, they come together and they even go and as far as to help select the CEO sometimes. And so they would, set out certain policies and stuff. And the CEO is the one who engages in the day-to-day running of the business. So the CEO, the board of directors is above the CEO. Number 11, which is the following is not a function of management. And you have options: controlling the use of funds, delegating work to subordinates, coordinating the work of employees, determining investment options for the employees. I mean, straight up, this has been a very easy paper thus far. So the answer for this one is D, determining investment options for the employees. Of course, the manager controls that's what the financial manager would do: control the use of funds. All the managers would control the funds for their departments. Delegating, the manager would be the ones who distribute work, give you the authority to do certain tasks, give you the tasks to complete, give you your workload. Coordinating the work of the employees, so the manager, of course, is the one who coordinates, as in bring all the resources together to get the work done. And so the best answer is D. I mean, the manager does not include itself, management does not include themselves in what you invest in. That's up to you, right? So if you want to invest in Bitcoin, you want to invest in stocks, bonds, whatever, that's totally up to you. Manager, no say in that whatsoever. That's your that's what you do with your personal monies. Number 12, the condensed version of the business plan is contained in the executive summary. So the executive summary is that part of the business plan that gives a brief rundown of the entire plan. So it condenses the entire plan into the executive summary. It contains all aspects of it: the production plan, the financial plan, the marketing plan. All those things are found in a smaller version. A little piece of it is found in the executive summary, and that's normally the first thing you would see in a business plan. That's the first thing the banks would look for when they're looking to give you money. If they want to give you a loan, they read over the executive summary and then they make the decision based on that. Number 13, which of the following is a regulatory requirement for an entrepreneur? And so you have A, using a credit card to transact business; B, offering hire purchase options to customers; C, paying national insurance to the government; and D, advertising the business locally and regionally. And of course, again, by a method of elimination, you can see that the answer is C, because this is the only one that is mandatory and is mandated by government. You have to pay your national insurance if that's a part of your country's setup. Using of credit card, there's no law that says you must use credit card. There's no regulation that says you must use credit card. There's no regulations that say you must offer higher purchase options to customers. Many stores don't even bother with higher purchase, right? D, advertising the business locally and regionally. Now, who can control that? The government doesn't insist that you advertise locally or regionally. You don't even have to advertise if you don't want to, right? So there's no regulation guiding these things. The only thing that regulation guides here would be C, paying national insurance to the government. Number 14, an analysis of the viability of a business idea and an examination of the different aspects of operating a business is known as is it A, business plan; B, market survey; C, feasibility study; or D, research proposal? And so the best answer here is C, the feasibility study. What is the feasibility study? Well, that's the definition up here, right? What you're doing is before you even start the business, before you even waste money on a business that might fail one time, you have to carry out a feasibility study. You have to see if the idea of a business that you have is practical, if it can be done in your market, if it's, as they say, feasible. Can it be done? Is it possible? So you have to carry out that research first before you venture further. And so the business plan is just after you would have said, okay, I think this business can work, it's feasible, then you proceed to do your business plan, because you're not going to waste time on the business plan knowing that the business cannot work and nobody going to give you a loan for that. Market survey, that would come under your business plan when doing marketing, so that's part of it. That's part of the business plan. Research proposal, again, you would have done this study to see, okay, it's good, so then now you would propose whatever the idea is to whatever board to see if they can agree with you, right? Research proposal. Now that's normal when you're doing research, when you're carrying out experiments, when you're doing thesis or whatever. You have to do a research proposal to see if what you want to research is something that they can help and agree with. All right, number 15. Cash used to secure a loan at the bank is referred to as, and you have options here: A, collateral; B, fixed assets; C, current assets; D, fixed deposits. And so the best answer here is collateral, straight up, right? The collateral is what you use to secure the loan. Fixed assets, yes, they can be used to secure the loan, but they're not cash. There will be things like a vehicle, a building, land, stuff like that. So they can be used to, yes, they can be used to secure loan, but they are not in the form of cash. They are just assets such as buildings that can be used to back your loan. Then you have current assets. That's just an financial term, an accounting term, and that just talks about whether you have your fixed or whatever assets you have on hand. And so some of it might include money, but in this case, it's wider than just money. So if we're talking specifically cash, it has to be the collateral. And fixed deposits, of course, again, some of it, as I say, fixed, so it's not as liquid, so it's not cash, cannot be cash. Cash is normally liquid, and so the best answer is collateral. So you get some monies, freeze them, and that's collateral for whatever loan you might be trying to acquire. Number 16, an entrepreneur may reduce the risk of loss by, of course, we've seen this many times before. Is it A, planning ahead? Of course, I circled it already, so it's A, clearly. But the other options: securing bank loans, sponsoring community projects, purchasing additional fixed assets. I question if CX even trade with this paper, boy, because some of these questions. Anyway, so planning ahead, clearly, that's how you avoid loss, right? By planning. So you plan to fail if you fail to plan. So you don't plan, of course, you're going to be failing. So securing bank loans, that's not exactly a way to reduce risk of loss, because you have a bank loan, and if you can't pay back for your loan, of course, they might end up taking back things that don't belong to them, your house, your land, whatever assets you put up for that loan. Sponsoring community projects, what if it doesn't come true? What if it doesn't work out? That's a big risk right there. So that's not one of them. Purchasing additional fixed assets, again, you don't know. You might purchase your assets and then business shut down because you didn't plan properly. So you just went ahead and buy the wrong thing, or you buy something in a market that's kind of slow. So so the idea, okay, I'm trying to stretch it, but it's A, planning ahead, right? Number 17. Which of the following factors prevents an agreement from being considered a valid contract? And so you have A, consideration; B, legal purpose; C, misrepresentation; and D, offer and acceptance. And so the best answer here, as we have circled here, is misrepresentation as C. And so let's look at the others. Consideration. Now, consideration speaks about that characteristic of a contract where both sides benefit from something. So both sides have to gain something, whether it's money, a good, or service. And so that does not prevent that's actually needed for a contract to be valid, but it doesn't prevent an agreement from being considered a valid contract. It's actually a part of a valid contract. Legal purpose, of course, you cannot enter into a contract where you are, let's say, going to commit a crime or something like that. And so which of the following prevents an agreement from being considered a valid contract? Now the thing is, if it's illegal, it don't even start. It ain't even start already. There's no contract at all, right? Now we're talking about being voided now, right? And so offer and acceptance, that's also a part of. So A, B, and D are all features of a valid contract. Misrepresentation is what would cause a contract to be voided. It basically did not exist in the first place because the things outlined in the contract were not truthful, maybe not on purpose, but both parties did not come to the same understanding of what's on the contract, and so therefore it's not a contract. Cannot be a contract because both parties have different ideas. And so the best answer here is misrepresentation. Number 18, the principle of insurance where individuals would be compensated for damages or losses incurred is referred to as, and of course, so they're basically defining one of these they're defining, and the answer is A, of course, indemnity. But why is it not B? Okay, it's not B because proximate cause refers to you insuring against the exact thing, something that's specific. For example, if you you have to go and insure against fire. And so if a fire burns down your house, you're going to get compensated for fire damage. You cannot insure for water and then fire burn down your house and expect to claim. That's not how it works. It's about the proximate cause. So if you have a flood insurance, house flood out damage, you're good to go. You have flood insurance, but wind come and tear down your house, that's not going to work. Insurable interest, that simply refers to the fact that whatever is being insured, you got to be the one, right? You got to be the one who is going to be setback, going to have a setback, going to suffer some kind of loss, right? So you cannot go and insure somebody else's property. You have to insure what belongs to you. If you have to be the one who's going to get the loss. And so insurable interest is, yes, it's a characteristic of insurance, but it's not the one that they refer to up there. And of course, the pooling of risk, D, is not the answer, because pooling of risk refers to all persons who are paying the premium. Everybody put a little piece of the money into a similar pool of risk. And so if something is to happen, you would take from that pool to help that other person, to give compensation to the other person. So just everybody with a similar risk, putting their monies together, so you're going to be less for each person. If one person wants to do all of that, it would cost more. But for everybody chipping in, you're going to be less, pulling the risk, so that when one person is affected, you pull, help the person. When the other person is affected, you pull, help that person. So this is not defining anything but a indemnity. Number 19, a purchase order is and so you have options, a request for additional goods. No, that would be a requisite form or requisite order. That's like you're between departments and you want to request something from one department to the next, and so you get a requisite form and fill out that. B, notification of goods received. That's not the answer for that. That's just that document just tells you, okay, you asked for this and you got it, and so you're telling the other person, okay, I received the goods, right? So that's not it. C, statement of outstanding debts. Of course, no. And so the answer is document offering to buy goods. So the purchase order is a document that says, okay, look, I would like to buy these goods from you. And so nothing is done as yet. There's no contract, there's nothing, but it's just a document to say, these are the goods that you're willing to buy, right? I'm willing to buy. These are the goods I'm willing to buy. So you're going to send, say, okay, first you're going to say, give me an estimate. Look at the estimate. You're going to send back and say, okay, based on the estimates of the items, this is what I'm requiring. 1, 2, 3, 4, 5. And that would be the purchase order. I would like to purchase 1, 2, 3, 4, 5 items. And so that's a document offering to buy goods, right? So you're the party who's buying, and so you give a document to say, okay, I'm willing to buy these goods. All right, good. So the last one for this video, number 20. We're going to do it in 20s, so 3 times. So 3 videos. So you know what to do. Subscribe to get the rest videos. All right, a contract may be discharged by, you have options here again. A, breach. B, change of mind. C, inconsideration. And D, misappropriation. And so the only best answer here is, of course, breach, right? Change of mind, you cannot up and change your mind when you're in a contract. It don't work like that. The only how change of mind can, effectively end the contract would be if both parties decided to agree that, okay, we're in different minds, let's do it. But one party cannot change their mind and expect the contract to be null and void, right? In consideration, that's not even really a part of this whole contract discussion, right? So it's consideration. Consideration refers to everybody benefiting, and so if you look at in consideration, it's saying that not everybody is benefiting, then you wouldn't have a contract to begin with, right? There's no contract to begin with for it to be discharged. So if in consideration is not really a thing as it relates to contract. Misappropriation, again, maybe they're trying to trick you into thinking misrepresentation, because misappropriation doesn't really have much to do with the formation of a contract like that, right? So breach is the best answer, because after the contract has been formed, the breach is one with the discharge that contract, meaning one party did not hold up to what they were supposed to do, right? So the best answer is A, breach. So we have come to the end of the first batch of questions for the 2020 June, July, August, May, June, July, August exams. So again, stay tuned for the others. You know what to do. Like, subscribe, and share. All right. Thanks for watching. Thanks for listening.